Let's start with a question. What if I told you the biggest economic collapse in modern history started not with a crisis, but with a party? Welcome to the 1920s, a decade of jazz, innovation, and what felt like endless prosperity. But hidden behind the confetti were cracks that would shatter the global economy. This is the story of the Great Depression, not just what happened, but why, and what it still teaches us today. Picture America after World War I. Europe was rebuilding. America, it was thriving. New inventions like cars, radios, and refrigerators weren't just luxuries, they became everyday purchases. Credit became normal. The stock market wasn't just for Wall Street elites anymore. Your barber, your teacher, your neighbor were all buying stocks. Why? Because it seemed like they only went up. From 1921 to 1929, the Dow Jones Industrial Average grew almost 500%. That kind of growth creates a powerful emotion, not just greed, but fear of missing out, 1920s style FOMO. And here's where things got risky. Most people weren't buying stocks with their own money. They were buying on margin. That means you put down just 10% of the stock's price and borrowed the rest from your broker. Think of it like buying a house with only a 10% down payment, but for stocks. And if the stock price fell, your broker could issue a margin call, demanding you pay up immediately.
By 1929, nearly 40% of stock purchases were on margin. The market wasn't just growing, it was growing on borrowed money. But not everyone was at the party. While stock prices soared, wages for most workers stayed flat. Industrial production raced ahead of what people could actually afford. Farmers were already struggling. Crop prices collapsed after WWI. Wealth inequality reached staggering levels. The top 1% held nearly 25% of the nation's wealth. It was like building a skyscraper on shaky ground. From the outside, everything looked strong, but the foundation was fragile. October 24, 1929. The market opened lower than expected. Then it started falling faster. Margin calls went out. People who had borrowed to buy stocks now had to sell to cover their debts. But everyone was selling at once. Panic spread across the trading floor. A group of bankers pooled money to buy stocks and stabilize prices, a temporary band-aid. Newspapers declared the crisis over. They were wrong. October 29, Black Tuesday. The market opened and immediately collapsed. 16.4 million shares traded, a record that stood for 40 years. The ticker tape ran hours behind. People didn't even know how much they'd lost until the end of the day. $14 billion vanished in hours. Adjusted for inflation, that's over $200 billion today. But here's what many miss. The stock market crash wasn't the Great Depression. It was the spark that lit the fuse. Banks had loaned all that margin money. When stocks crashed, those loans went bad. Banks started to fail. People panicked and rushed to withdraw their savings, which made even healthy banks collapse. Between 1929 and 1933, 9,000 U.S. banks failed. 1/3 of all banks. Gone. There was no FDIC insurance back then. If your bank failed, your savings disappeared. Poof. Unemployment skyrocketed to 25%. 1 in 4 workers without a job. In some cities, it was over 50%. This wasn't just numbers. This was fathers selling apples on street corners, families living in shanty towns called Hoovervilles, former bankers standing in bread lines. And there was no safety net, no unemployment benefits, no food stamps. If you didn't work, you didn't eat. Why did this become a global depression? One word: gold. Most countries were on the gold standard, meaning their currency was backed by gold.
Reserves. When U.S. banks failed, American investors pulled money from Europe. Gold flowed out of European banks, forcing them to raise interest rates during a recession, the worst possible move. Then America made it worse. In 1930, Congress passed the Smoot-Hawley Tariff Act, raising taxes on thousands of imported goods to protect American jobs. Other countries retaliated with their own tariffs. World trade collapsed by 65%. Farmers lost export markets. Factories shut down. It was like during a flood. Every country built a wall around themselves, and they all drowned separately. Germany, already crippled by World War I reparations, saw unemployment hit 30%. That economic despair helped fuel the rise of the Nazi Party. In the UK, exports were cut in half. In Australia, wool prices collapsed. In Latin America, commodity exports dried up. This wasn't an American recession. It was a global economic heart attack. President Herbert Hoover believed in rugged individualism, that government shouldn't intervene. He thought private charity would solve the crisis. Instead, he raised taxes in 1932 to balance the budget during a depression. Imagine seeing a house on fire and deciding to cut the water supply to save money. By 1932, shantytowns were named Hoovervilles. Empty pockets turned inside out were called Hoover flags. 1933, Franklin D. Roosevelt takes office with a famous line, "The only thing we have to fear is fear itself." He launched the New Deal, a massive government intervention. The CCC put young men to work planting trees. The WPA built roads, schools, and hospitals. The FDIC insured bank deposits. Social Security protected the elderly. For the first time, the government became the spender of last resort. Did the New Deal work? Yes and no. It provided relief and hope, but unemployment was still 15% in 1939. Many economists argue it was World War II that truly ended the Depression. Massive government spending on war production created jobs, retooled factories, and mobilized the economy. By 1944, unemployment was just 1.2%. Sometimes the solution is blunt. When no one spends, someone has to start. The Depression left permanent changes. The FDIC insures your bank deposits. The SEC regulates the stock market.
Social Security protects retirees. We abandoned the gold standard. These weren't random policies. They were direct responses to 1929's failures. See the echoes today? 1920s margin buying, today's crypto leverage and meme stock speculation. 1920s wealth inequality, today's top 1% holding historic wealth shares. Smoot-Hawley tariffs, modern trade tensions and protectionism. History doesn't repeat, but it often rhymes. The Great Depression taught us that economies aren't machines. They're ecosystems. They need balance. They need regulation. They need a safety net. Most of all, they need us to remember that "this time is different" are the 4 most dangerous words in economics. Thanks for learning with us at the Economic Autopsy. Stay curious.